Understanding options, the basics of option markets for investors. Ever wondered how some investors profit whether markets go up, down, or sideways? Or how professionals manage risk in volatile times? The answer often lies in the world of options, one of the most flexible and powerful tools in modern investing. Welcome to the channel. My name is Anthony Gismondi, and I'm a senior wealth advisor at Aegis Wealth Management, a part of Wellington-Altus Private Wealth. The goal of this channel is to educate Canadians on the complexities of personal finance and provide clarity to help you reach your goals. If you're new here, please subscribe and click the like button. What are options and how do they work? Let's start with the basics. Options are financial contracts that give you the right, but not the obligation, to buy or sell an underlying asset, like a stock or index, at a specific price within a certain time frame. Think of options as a way to lock in a price for a future transaction. They're called derivatives because their value is derived from something else, usually a stock. Why do investors use options? Options aren't just for speculators. Here's why investors use them. Hedging. Protect your portfolio from downside risk, like buying insurance. Generating income. Sell options to collect premiums, such as covered call strategies. Speculation. Bet on a price movement with limited capital. Leverage. Control more shares with less money, amplifying your potential gains and losses. Strategic flexibility. Combine options in creative ways to profit from different market scenarios. The main components of an options contract. There are two main types of options: calls and puts. But before we dive into how options work, let's break down the key parts of every options contract. The underlying asset, the stock or index the option is based on. The strike price. This is the price at which you can buy or sell the option. Expiration date, the last day the option can be exercised. Premium, that's the price you pay to buy the option. Contract size, typically one contract represents 100 shares of the underlying asset. Calls, puts, and the rights versus obligations of buyers and sellers. Now let's talk about the two main types of options, calls and puts, and what it means to buy or sell each one. And I'll give you a few real-life examples. Call options. Buying a call. Buying a call means you have the right, but not the obligation, to buy the underlying asset at the strike price before expiration. You pay a premium for this right. If the stock goes up, you can buy at the lower strike price and profit. Maximum risk is the premium that you paid. For example, you believe Apple's next iPhone launch will boost the stock price. You're optimistic. So what do? You buy a call option on Apple with a strike price of $200 expiring in a month. If Apple stock rises above 200, let's say to 230, you can buy shares at 200, sell at 230, profiting from the difference, minus the premium you paid. Why would you do this? To profit from a potential price increase with less capital than buying the actual stock outright. How about selling or writing a call? You take on the obligation to sell the asset at the strike price if the buyer chooses to exercise the option. You collect a premium. If the stock soars, you could be forced to sell at a price much lower than the market value. What's the potential risk? Well, it's unlimited if you don't own the stock. Something called a naked call. You don't want to do that. Scenario. You own Amazon shares and you want to generate extra income. So in this example, you sell a call option on Amazon with a strike price of $250 expiring in a month. If Amazon stays below $250, the option expires worthless and you keep the premium. If Amazon rises above $250, you must sell your shares at $250, even if the market price is higher, but you still keep the premium. Why would you do this? To earn extra income, which is a premium, on shares you already own. This is called a covered call. How about put options? Buying a put. You have the right, but not the obligation, to sell the underlying asset at the strike price before expiration. You pay a premium for this right. If the stock drops, you can sell at the higher strike price and profit. What's the maximum risk? The amount of premium you paid. Here's a scenario. You're worried about Microsoft might drop after their earnings, but you don't want to sell your shares. So in this example, you buy a put option on Microsoft with a strike price of $500 expiring in a month. If Microsoft falls below 500, let's say 470, you can sell at 500, limiting your losses. Why would you do this? To protect your portfolio from a potential drop. It's kind of like buying insurance, selling or writing a put. Here, you take on the obligation to buy the asset at the strike price if the buyer exercises the option. You collect the premium. But if the stock falls sharply, you could be forced to buy it at a much higher price than the market value. What's the potential risk here? It's significant, especially if the stock goes to zero. Here's a scenario. You want to buy Google shares, but only if the price drops, and you like to get paid while you wait. So in this example, you sell a put option on Alphabet, the parent company of Google, with a strike price of 120, expiring in a month. If Alphabet stays above 120, the option expires worthless, and you keep the premium. But if Alphabet falls below 120, you must buy the shares at 120. Even if the market price is lower, you still keep the premium. Why would you do this? To potentially buy shares at a lower price, while earning income if the stock doesn't drop. So in summary, buyers of options, calls or puts, have rights they can choose to exercise, but don't have to. The risk is limited to the premium paid. Sellers or writers of options have obligations. They must fulfill the contract if exercised, and the risk can be much higher. Let's talk about something called in the money versus out of the money. Options are often described as in the money or out of the money. What's an in the money mean? It means a call option is in the money if the stock price is above the strike price. A put option is in the money if the stock price is below the strike price. How about out of the money options? A call is out of the money if the stock price is below the strike price, and a put is out of the money if the stock price is above the strike price. Why does this matter? Because only in the money options have intrinsic value at expiration, means they're worth something. Out of the money options expire worthless. The risks of option writing and why most investors should rely on professionals. While options can be powerful, writing, selling options is risky, complicated, and time-consuming. Here's why. Potential for unlimited losses, especially when selling naked calls or puts. They're complex strategies. Advanced option strategies require deep knowledge and constant monitoring. There's emotional discipline. Fast-moving markets can lead to costly mistakes. Diversification. Managing risk properly often requires significant capital and a diversified portfolio. So what's the bottom line? For most investors, options trading is best left to professional money managers who have the expertise, sizable teams, and resources to manage that risk effectively. They can use options as part of a broader, diversified strategy, so you don't have to lose sleep over market swings. In closing, options can be a valuable tool for managing risk and enhancing returns, but they're not for everyone. If you're curious about how options might fit in your investment plan, talk to a qualified advisor or professional money manager. If you found this video helpful, give it a like, subscribe to the channel, and drop a comment if you have questions about options or investing. Thanks for watching, and I'll see you in the next video.